Drake and Daniel applied for the exact same car loan at the exact same dealership, the exact same week. Same income, similar down payment, nearly identical car. Daniel's offer came back at one rate. Drake's came back at a rate nearly 4 times higher. Neither of them fully understood why, until they actually looked at the one number quietly running underneath almost every financial decision either of them makes. This isn't a video about becoming a credit expert. It's about the handful of specific things that number is actually measuring, because most people can tell you their score exists without being able to explain a single thing that moves it. And it isn't only loans. The same number quietly follows into renting an apartment, insurance premiums, and more, decisions that don't obviously look like credit at all, but are shaped by the exact same 3 digits underneath. Quick one before we get into it: if this kind of real numbers breakdown is useful, hit subscribe, new video every week. A credit score is a prediction. Specifically, a prediction of how likely someone is to repay a loan on time, built entirely from the information already sitting in their credit report. It isn't a judgment of character or income. It's a number a lender uses to estimate risk before deciding what to offer. Most scores run from 300 to 850, using a model most lenders call FICO Score 8. Above 800 is considered exceptional. The high 700s are very good. The high 600s and low 700s are simply good. Below that, into fair and poor territory, is where the real cost differences start showing up, which is exactly where Drake's score was sitting without him realizing it. One more thing worth knowing before getting into what moves it: there isn't just one score. Different bureaus and different scoring models can produce slightly different numbers for the same person, depending on what data they're working from and the day it was calculated. The 5 factors underneath stay the same either way, which is the part actually worth understanding. The single biggest factor, worth 35% of the entire score, is payment history. Simply, has every bill been paid on time? It's the most heavily weighted piece by a wide margin. And for good reason, it's the most direct signal a lender has for predicting future behavior. Drake missed one payment 8 months ago, a bill that slipped through during a busy week, paid a few days late, an easy thing to shrug off in the moment. A single missed payment can drop a score by 50 to 100 points, and it can take months to fully recover, even after the balance itself is paid in full. Daniel's history has no gaps at all, not because he's naturally more disciplined, but because every bill on his end is set to auto-pay for at least the minimum amount due. It's a small setup step that removes the entire category of risk this one factor is measuring. The damage from a single missed payment does fade over time, especially if every payment after it lands on time. It's not a permanent mark, but it's also not something that resets the moment the balance gets paid. The clock on recovery starts the day the payment is actually made, not the day it was due. The second biggest factor, worth 30%, is utilization. How much of the available credit is actually being used at any given moment? Lenders want to see this kept under 30% of any single limit and of total available credit combined. For the strongest possible score, under 10% is the real target. Drake pays his balance in full every single month and assumed that meant utilization couldn't possibly be a problem for him. But most card issuers report the balance as of the statement closing date, not after the payment clears, so a card run close to its limit right before the statement cuts can still show high utilization on the report, regardless of what happens to the balance a few days later. Daniel's fix was simple once he understood the mechanism: pay down the balance before the statement closes, not just before the due date. Same spending habits, same full payoff every month, just timed against the actual date that gets reported. Total available credit matters here too, not just any single card's limit. Opening a second card, used responsibly, widens the total pool utilization is measured against, which is one of the few cases where having more available credit, left mostly unused, actually helps rather than tempts. The third factor, worth 15%, is length of credit history, specifically the average age of every open account. An older average age generally helps the score, which leads directly into one of the most common credit mistakes: closing an old, unused card to clean things up. Closing that card does two things at once, both of them working against the score. It removes one of the oldest accounts from the average age calculation, and it shrinks total available credit, which, combined with factor 2, can actually push utilization higher on whatever's left open, even if spending hasn't changed at all. Daniel kept his oldest card open on purpose, using it just often enough, a single small recurring charge paid off automatically, to keep it active without actively using it day to day. This is exactly why leaving an old card completely unused can eventually backfire too. Some issuers close accounts automatically after a long enough stretch of no activity at all, which quietly triggers the same average age and available credit hit as closing it directly. The fourth factor, worth 10%, is credit mix. Whether a person has experience managing different types of credit, typically a revolving account like a card alongside an installment loan like an auto loan or mortgage, it's a smaller factor, and not something worth taking on new debt just to chase. Drake once considered taking out a small personal loan for no reason other than wanting a second type of credit on file. Worth talking him out of that instinct directly, credit mix is only 10% of the score, and it's just one of 5 factors making up that total. Paying real interest on a loan taken out purely to fill one small slice of a formula almost never comes out ahead of simply leaving that slice alone and letting ordinary life, a car loan, a mortgage down the road, fill it naturally on its own timeline. The fifth factor, also worth 10%, is new credit, specifically hard inquiries from applying for financing. Each individual hard inquiry can drop a score by 5 to 10 points temporarily, which is exactly why applying for several different cards in a short window, chasing sign-up bonuses, can quietly work against someone even if every application gets approved. Add all 5 together and the picture becomes clear. 35% payment history, 30% utilization, 15% length of history, and 10% each for mix and new credit. 2 of the 5 factors alone account for nearly 2/3 of the entire score, which is exactly why the next section focuses on what those 2 factors are actually worth in real dollars. Here's where all 5 factors turn into real dollars. On a $400,000 mortgage, the difference between a 620 score and a 760 score can mean over $200 more per month, which adds up to more than $72,000 in extra interest across a full 30-year term, for the exact same amount borrowed on the exact same house. Auto loans show the same pattern at a smaller scale. A 580 score might mean an interest rate around 15%, while a 750-plus score might land closer to 4% on the same vehicle, a gap worth thousands of dollars over the life of even an ordinary car loan. This is exactly the gap that showed up in Drake's own dealership offer at the start of this video. Not bad luck, and not a random decision by the lender, but the direct, measurable output of one missed payment and a utilization number he never knew was being tracked at the wrong moment of the month. Credit cards follow the same shape. Strong credit typically qualifies for cards with genuinely competitive terms, while weaker credit is often limited to high-interest products, sometimes above 25% APR, or a secured card requiring an upfront deposit just to get started at all. Even among approved applicants, the same score gap shows up in the fine print. A stronger score tends to unlock higher starting credit limits and richer reward structures, while a weaker score often means a lower limit, fewer perks, and sometimes an annual fee just to hold the card at all, the same underlying number, quietly setting the terms on almost every card offer that comes through the mail. The reach of this number goes well past loans. Landlords routinely run credit checks on prospective tenants. Below a 620 score, an application can be rejected outright or approved only with a substantially larger security deposit required upfront. Insurance companies factor it in too. Auto and homeowners insurers commonly purchase credit information as part of assessing risk, and a lower score can directly translate into a higher premium, a cost that has nothing to do with driving record or claims history at all. Utility and cell phone providers check it too, particularly for anyone without an established payment history. A lower score, or no credit file at all, can mean a required security deposit just to open a new account, one more everyday cost stacked on top of loans, renting, and insurance for the exact same 3 digits. It's worth being direct about why this number reaches so far. Credit bureaus sell this information to any business that requests it for a legitimate purpose: lenders, landlords, insurers. And in some states, even employers running a background check as part of hiring. One number, sold repeatedly, shaping decisions across almost every part of adult financial life. Myth 1. Checking your own credit score hurts it. It doesn't. That's a soft inquiry, and it carries no impact at all. Only hard inquiries from an actual credit application affect the score, which means there's no real reason to avoid checking regularly. Myth 2. Carrying a balance instead of paying in full helps the score. It doesn't. It only adds interest cost. Paying in full every month is always the better move, for the score and for the wallet. Myth 3, already covered but worth naming directly, closing old cards helps clean up a credit file. It doesn't. It typically hurts, for the exact reasons covered under length of history and utilization, and no, carrying debt on purpose is never required to have a good score either. All three myths point at the same underlying misunderstanding: treating the score as something that responds to effort or intention, rather than a small, specific set of mechanical rules. Once the actual rules are clear, most of the guesswork disappears. For anyone starting from scratch or recovering from a rough stretch, a secured card is the most common entry point. A deposit, typically $200 to $500, becomes the credit limit itself, with the option to graduate to a regular, unsecured card after 6 to 12 months of on-time use. Becoming an authorized user on a trusted family member's older, well-managed card is another path. Their account history can help build a newer file, without that person needing to actually use the card themselves. And regardless of where a score currently stands, it's worth pulling a full credit report and reading it closely. Up to 30% of reports contain at least one real error. An account that should be closed still showing open, a balance that never updated. Disputing it directly with the reporting bureau is free, and often the single fastest correction available. One more path worth knowing: a credit builder loan, structured backward from a typical loan. The amount borrowed is held by the lender until it's fully paid off through a series of small, on-time payments. Each one reported to the bureaus, building payment history directly, without ever handing over spending money upfront at all. None of this happens overnight, and it shouldn't be expected to. Moving from no credit file at all into a solidly good score realistically takes 12 to 18 months of consistent on-time payments and low utilization. There's no legitimate shortcut that compresses that timeline. Any product or service promising an instant fix is worth being skeptical of, since the underlying math simply doesn't allow it. Pay every bill on time, it's 35% of the score on its own. Keep utilization under 30%, ideally under 10%, and time it against the statement date, not just the due date. Keep old accounts open. Don't chase new credit applications back to back. And check the report itself for errors, since nearly a third of them contain one. None of these 5 factors require a higher income or a dramatic financial overhaul. They just require actually understanding what the number is measuring, which is the part almost nobody ever gets taught. If there's only time for one habit, make it this: automate every bill so a missed payment becomes structurally difficult to have happen at all. That single move covers 35% of the score by itself, and it makes almost everything else on this list far easier to stay on top of, month after month, without having to think about it at all. This video is for educational purposes only and is not personalized financial advice. If breaking down real numbers like this is useful, subscribe. New video every week. Next time, we get into the numbers sitting in your checking account right now, and why keeping too much of it there is quietly costing you too.